Hello and welcome to ET Market Smart Talk. I'm your host Shwetajananda, and today we turn our focus to the US markets, where a strong rally, rising geopolitical tensions, and currency movements are raising important questions for global investors, and especially investors who have invested in the US stocks from India. Now, should investors sort of add US equities or book profit as we look ahead to 2026? Well, how do geopolitics and the dollar, the rupee factor comes into the play? Well, to decode all this, I'm joined by Pratik Agarwal, who's MD and CEO of Motilal Oswal Asset Management Company. Let's quickly dive in. Thank you so much, Pratik, for joining us.
Thanks, Satish, for having me. Looking forward to this conversation.
Thank you so much for taking the time out, Pratik. And could a potential US military operation that we saw in Venezuela impact US financial markets, and how might this sort of affect the portfolio of investors with exposure to US assets?
I think geopolitical risk is something which we have gotten used to over the last 2 3 years,
Yeah.
and there have been many sort of these small. I wouldn't say small, but countries that are having these sort of situations, like you have
Yeah.
stuff that's happening in Russia, you have stuff that's happening in the US, Middle East. So obviously there is always a risk factor for
Mm.
geopolitical as a risk factor to equity markets. We
Mhm.
believe that you know since the conversation today is about the US markets, we believe that this doesn't really impact the US markets negatively, in the sense
Okay.
that earnings of companies, and these are large companies which with global business models, do
Mm.
not really get affected, as such. If you look at the US markets today,
Yeah.
most of your the wealth creation that has happened in the US markets in the last 10 to 15 years time have really happened in the top 15 20 stocks.
Sure.
And I think those top 15 20 stocks is what where most of your portfolio is today. And we don't
Mm.
see geopolitical risk happening in those companies because they are pretty much ahead of the world in terms of technology, in
Right.
terms of I think distribution, and their
Mm.
business models are also very global. Just to
Okay.
put you a statistic, 60% of the revenues for the S&P 500, and this is 500 stocks, this is not top 20 stocks, are actually outside, are coming from outside the US.
Right.
So what we're seeing today is that the US is no more the US market is no more a US centric market, it's a global market. We
Sure.
are, companies like Amazon, Google, Netflix, Nvidia are pretty much global companies.
Pretty
They
much.
have India is also heavily exposed to these companies, and
Sure.
we believe that these companies have incredible distribution, brand, and even though honestly China can come close to them in terms of technology prowess, we
Yes.
believe that the brand equity associated with China may not be good enough for the
Mm.
world to utilize it, apart from obviously China itself. So we believe that for investors today, if you are looking at investing in the future, then I think
Sure.
US markets offer good opportunities. Yes, there is geopolitical strife happening, and there is
Yeah.
obviously question marks on what would happen with the US acquire Venezuela. Will the US also
Mm.
looking at they're also looking at Greenland apparently, for their
Yes.
rare minerals.
Mm.
So I think resource war is obviously something which will be an issue going forward. So we'll have to see how this sort of plays out, but at least in the short to medium term, we don't see an impact.
Absolutely. And yes, you rightly pointed out that there are other countries at play as well at this point in time. And how will that shape up in the next few months? I think the time will tell. But yes, just to add to that bit, could heightened geopolitical stress trigger a shift in global capital flows towards the US safe haven assets, or it might accelerate diversification away from the US, or, probably ETFs could come into the play, for investors.
Yeah, so actually, what has happened is that over the last 3 to 4 years' time, capital has actually moved away from emerging markets, and the US tends to
Mhm.
be the safe haven for equities. Like
Sure.
how in India, the haven, for a lot of investors,
Mm.
haven tends to be fixed income or maybe gold, for some, yeah. I think for most equity investors who are investing
Mm.
globally, the haven tends to be US, and that I
Yeah.
think is continued to be a safe haven.
Sure.
I mean, the issue is more to do with, I think what is the opportunity for AI for a lot of these companies. You really have to. Today, we think the US is one big bet on AI. To be honest,
Mm,
especially if
mm,
you look at broad-based indexes out there like a Nasdaq or an S&P. So we believe that. Um, obviously global capital and also countries like India, at least for global investors, tend to be very expensive.
sure.
So yes, we don't really see a shift when it comes to global flows.
Mm,
In fact, having access to sort of captive oil reserves, might even make it easier to invest in the US today.
okay.
So this may in some point be good for the US economy also,
Right.
because you have refineries out there that are only able to process this very heavy oil, which you get in
Right.
Venezuela. And I think to keep those refineries running, you need
Mm,
oil from Venezuela and Canada, to put in. So
mm,
I think it's most good for the U.S. economy, which
mm,
is pretty much, I think if you look at the technicalities, especially for this type of Venezuela, the U.S. tends to be very heavy on shale gas.
yes. Mm,
But shale gas is not something which can be refined in the US very well. You need
mm,
a different type of oil, and that oil comes from maybe three or four places in the world. Russia
okay.
being one, Middle East being one, Canada being one, and I think Venezuela has the highest reserves. So in
Nice.
that sense, it may be a good thing for the U.S. economy, at least in terms of companies. But overall, I
Right.
think, as I said, I think
Mm.
we don't see capital movements changing for global investors because of this.
Absolutely. And in a scenario of escalating geopolitical uncertainty, which asset classes sort of tend to benefit the most? US equities, bonds, gold, or the dollar? Dollar, we've already seen, Indian rupee sort of, getting hit towards 90 odd levels. And yes, there's some bit of, chatter that yes, it's going to go to towards 9,500, and it can go on and on. But yes, there's slight bit of uncertainty there as well. Over to you, Pratik, on that. Yes.
Yeah, so for investors in India, I think there are two benefits of investing abroad.
Mm.
One benefit is you're investing into stocks that are pretty much a part of our daily lives today.
Yes.
Um, but also these stocks are completely uncorrelated to Indian markets. What that means
Mm.
is that when Indian markets do well, US does badly, and vice versa. So Indian markets, for example, last 12 months has not done well,
Has not
um,
done. Yeah.
especially in mid and small caps, and US has done extremely well. So I think one is you're
Mm.
buying an asset class which is high return and low correlation. The second asset
Sure.
class you're buying when you're investing abroad is actually the US dollar.
Yeah.
And I think so. If you look at, say, the Nasdaq index, the
Mm.
Nasdaq has stayed on INR 25% CAGR approximately last 10 to 15 years.
Okay.
The Nasdaq itself is done about 20-21%. The added 4 to
Mm.
5% has come from depreciation of rupee.
Yes.
So
Okay.
I think by investing abroad, you're not only making money of the stocks, but you're also making money of the USD. And we
USD.
believe that we definitely think there will be a scenario when the dollar goes to 95. There'll be a
Mm.
scenario when the dollar goes to 100. A scenario when it
Yeah.
goes to 110 also. That's unfortunate, but
Right.
that's what it is. But we don't know when. It might happen, say, in 6 months. It might happen in 6 years.
Yeah.
So what we've seen is in terms of depreciation, it's not like
Mm.
it's not a straight line. It happens in
Mm.
spots. So
Mm.
we remember we had a spot about 3 years back when it went from 75 to 85.
Yeah.
This year we've had a spot which has gone from 82, 83 to 90, 90 91.
Sure.
And we don't know where the spot will end. But we've
Mm.
seen that it's not really consistent. It happens every 3 to 5 years time. But when it happens quite sharply.
Gotcha.
Um,
Okay.
so, so I think from an investor point of view,
Mm.
the dollar is going to appreciate. That's just how it is, and I think we want to tell investors that your purchasing power will reduce by approximately 2 to 4% every year because the dollar getting stronger. So I think
Yeah.
it makes sense to have some of your money in dollar-based assets. So I think that's the point here on
Mm.
what investors should do with this scenario.
Absolutely rightly put there. And another question that I have, and especially this comes from an Indian investor point of view, that as we look ahead to 2026, should investors sort of consider adding their risks? existing US portfolio add on to that, or does the sort of recent rally warrant some bit of profit booking that is coming?
Yeah, so very hard to make a short-term call on where the markets are and where the markets will be. But we'll talk about where we are right now. There is this big expectation out of AI, massive
Yeah.
expectations, and the technology is sound. We all know that it's going to play a massive role in the future. We
Mm.
think that, but just like the internet bubble happened in '99, but the actual large scale adoption of the internet happened in 2015.
Mm.
So we believe that today the markets are favoring a scenario where people will start using AI, companies will start using AI, companies will
Mm.
start laying off people tomorrow. But the real scenario is that there is a lot of inertia built into the world today.
Sure.
And I think it probably take maybe 7 to 10 years for it to get large scale adoption. So I think that's at least in our perspective, that's the mismatch that we see today, where an investor coming in today is coming into a market which is extremely quite
Mm.
bullish. There is a lot of liquidity flying around in the US. So I would say that yes, the markets are quite heated. My Our view would be to stagger your investments in the US market. Maybe that might make sense. Or if you have a long term bet, say 10 years, then you can do a lump sum. But yes, it is in the short term looking a little bit risky, given the fact that these companies are obviously growing, but also this there is a huge expectation built into AI, and
Mm.
it's very hard to see how this will play out in the short to medium term.
Okay, absolutely. And you did talk about that rupee depreciating, towards 95 or 100 levels. Probably not now, in some time. So probably my next question is something around that: is at what level, does the rupee depreciation start becoming a macro concern for India from, let's say, inflation or imports or fiscal standpoint?
Yeah, so right now it's not a macro problem because oil prices are quite muted.
Absolutely, yes. It's
So
not
I
short of
think
it.
India is a oil dependent country.
Sure.
So I think that's the biggest, I would say, source of forex, and our oil needs will keep on going up and up.
Mm.
So I think the rupee obviously does play a big role there in the sense that a depreciate rupee plus higher oil price puts a larger burden on our balance sheet, on our
Mm.
forex reserves.
Yes.
So we believe that right now it's not as big a problem. I mean, it is a problem in the sense that things are becoming more expensive, but
Yeah.
from a balance sheet point of view, from a cost point of view, oil prices are still not relatively okay. So
Yes.
we don't see it to be a large like a red flag. Having said
Okay.
that, anything where there is a sport should be looked at. You've seen
Mm.
depreciation of good 7 to 10%, which is a pretty high number in the
Yeah.
last year and a half. So I would
Mm.
say that RBI is obviously trying whatever it can to stabilize it, but this is
Sure.
so we believe that it is this sport has been quite alarming.
Mm.
But we believe that it's not it doesn't really cascade into obviously it does affect industry because raw materials become very expensive.
Mm. Mm.
All that does happen.
Yeah.
Gold, for example, we're importing a lot of gold and silver, so there obviously
Mm.
things are becoming expensive,
Mhm.
but not a very alarming situation at this point.
Right. And lastly, does a weak rupee strengthen the case for maintaining long-term US exposure, or does it sort of argue for caution on fresh allocations?
Yeah, so I would say that you know the best
Mm.
strategy to play international markets is a strategy of allocation.
Okay.
Where you say that what, I will have a 15% or a 20% allocation to international markets, and
Okay.
I will keep that consistent for life.
Uh-huh.
So that is the best strategy. I think if that 15% has run up to 20%, maybe trim it down to back to 15%. Or if
Uh-huh.
you are at 10%, you can invest more and keep it to 15%. So our view is that the point of international asset allocation is for diversification. We believe that the wealth creation opportunity in India is far higher than the US. India is a
Correct.
growth market. India valuations are much better. India, obviously, has a lot more, is a growing market.
Sure.
So we believe that the whole point about investing in the US is more to do with diversification. When Indian markets do badly, you have something which keeps your portfolio stable.
Yes.
So I think that's the point, and I strongly believe that if international funds are less than 5% of your portfolio, and don't
Right.
even have it, and just stick to domestic funds or domestic stocks. But if you really want to have an allocation, have a minimum allocation of 10%. 10 to 20% is a good number, and stick to that. So if it goes above certain threshold, you can trim it. If it goes below, you can buy more. I think that's the best way to play.
All right. Well, Pratik, on that note, thank you so much for taking the time out. It's always a pleasure interacting with you on US markets. Thank you so much for taking the time
Thank you
out
so
there.
much, Hitesh, and thank you, ET Markets, for having me.